Ted Thatcher is with us, President Bright Lake Wealth Management. How are you feeling? Because the soft landing narrative is back. Goldman Sachs now less likelihood of a recession than they thought even 2 weeks ago. What are you thinking?
No, Nicole, I think that conversation very much is squarely in the crossholds here, or the crosshairs here. Obviously, the consumer, though, is really what I look to. Because if we look at the value in the financial markets, I think it's easy for us to start to say, hey, obviously we're at all-time highs or close to it now. Last week was the best week in the S&P all year. Are we out of the woods? And my eyes, again, go to the consumer. At the end of the day, the consumer sentiment numbers are still down year over year. And the most recent report highlighted that Americans are still very, very concerned about inflation. We see repos up. We see Americans are holding $1 trillion in credit card debt now. And so it is simply my belief that it's impossible to have a conversation about a completely soft landing without also considering where the consumer is at. And I think that ultimately they're feeling a lot of pressure still.
Right. You said, what about inflation and bank stress? What's happening here, and is there a correlation?
So I do think that at the end of the day, because of how high rates have been, it's put the banks under pressure. We do have to remember that at the end of the day, we're still higher in terms of the federal funds rate than where we were when Silicon Valley Bank and Signature Bank collapsed last spring. And so the Fed ended its bank term funding program. And so, at least in my opinion, there is still some pressure that the banks are feeling. Of course, we do still see, though, the tone that Jerome Powell has taken talking to the Senate Banking Committee from the last Fed meeting, of course. It looks very likely that we're going to get a rate decrease here in September. The market's looking for it. And so hopefully we'll start to relieve that stress. Now, we are still, of course, above the rate of inflation the Fed's saying they are targeting. However, given Jerome Powell's comments that that's not the only number they're looking at now, obviously starting to consider the unemployment rate, I think that they're willing to accept a little bit higher than that 2% inflation number if it means keeping us out of the ditch, as it were.
What do you tell investors? How do they make money now?
Sure. Well, I think that I've gotten the question a whole bunch lately of, well, how do we stay aggressive and still look for good returns? Obviously, equity markets have performed very well this year, highlighted by NVIDIA, highlighted by big technology. And so I've started to have a lot of conversations with folks that are a little bit worried that tech's overextended. And so I think when it comes to strategic plays in the market right now, I would look at it in two fronts. First, from a macroeconomic front, and then secondly, I would kind of go toward a brand. And so we'll start with the first there. On the macroeconomic side, how often in the last 2 years, or especially in 2022 and 2023, did we hear about that teeter-totter, right? Of course, as rates had gone up with the Fed, bond values coming down, that relationship, that inverse relationship. Well, with us now being sort of poised in the marketplace to see rate decreases, I think a way to keep the foot on the gas is to say, well, let's look at some levered long-term bonds. And therefore, I look at a ticker symbol like a TMF, 20-year plus Treasury bonds, triple leveraged. Now, obviously, we got to be careful when we think about leverage. But with a lowering interest rate environment, that could be a strategic play to stay aggressive if you're looking to.
It's amazing how, you got to mix it up, right? You have to have the fixed income. I actually was talking with someone over the weekend who now is into doing annuities. There are people who love annuities and those who stay away from them. Do you have any thoughts on that?
I think with everything, Nicole, we see so many times that things want to be black or white, right? Annuities are always the right choice, or annuities are never the right choice. I think for most folks, almost always, it's more in the gray. And so I think that there are, plenty of good annuities out there. There are plenty of bad annuities out there. It really comes down to the details. But I think right now with rates as high as they are, if you're trying to look for an annuity, the rates are pretty dang competitive. And so if, again, from a timing standpoint, that doesn't put you behind the ball there at all. I think it's actually an opportune time if you're going to look for one. Now, to get back to my other point there on the branding side, I do think that if we look at Nike, there might be some opportunities there as well. If you look at the company's history since its all-time high in 2021, the company has literally lost half of its value since then. And it's now trading at about 22 price to earnings ratio, which is 39% below its 10-year historic average. And so John Donahue was hired in January of 2020 as the CEO to, I think, really bring the company into the future. And he had previously been the CEO at eBay and the chairman at PayPal. And honestly, I think he got maybe mixed reviews upon his hire. But ultimately, while he has digitized the company in many ways, I think, unfortunately, the brand has suffered. Nike, at the end of the day, I would argue, is one of the top 10 brands in the consumer space in the country. And if we look at the year-to-date performance, Nike's lost 20% of its value compared to Adidas's gaining 20% in value. And so I don't see a categorical issue there. And across the S&P 500, it's doubled across that time. And so at the end of the day, I think John Donahue's in a situation where he's going to have to own his performance. And if we look ahead 2 or 3 years, I think we might look at this as a buying opportunity for Nike.
All right. Ted, thank you. Ted Thatcher, President, Bright Lake Wealth Management. Good to see you, Ted.